Hey guys, in this video I'm going to show you exactly how to turn a 1-1-2 trade into a ratio hedge, when to do it and why to do it and what that looks like. Because again, if you're scared of an upcoming market crash and your 1-1-2s leaving you with thousands of dollars of losses, because each 1-1-2 could turn into a $3,000 loss based on how we do stop losses. And so if you want to prevent that, let me show you how to turn the trade into a ratio hedge. So again, when we have a 1-1-2 trade, the first thing we need to understand is what the profit graph looks like. So again, you can just click on a group and click analysis, and this will show you the 1-1-2 trade right here. Now again, this is what it looks like. So if the market stays the same or goes up, we make about $1,500. If the market drops into our bear trap level, we'll make about $3,000 at the expiration date, and that's kind of how this trade works. Now the real thing is we set up a 300% stop loss on these trades. So that means that one of these trades of $1,500 is kind of that level. So 3x that. So that means I could lose $4,500 if this trade were to pull back quickly, the market were to crash, and volatility were to spike. And so a $4,500 loss per trade could be massive if I have like 10 trades, right? That's a $45,000 loss. So how do we help protect our account from that? And a ratio hedge is the best way to do it. When I trade 1-1-2s, which is all I do now, I make sure to have at least one ratio hedge on for every 5 to 6 positions. Why? Well, because it'll cover all those losses. And look, let me show you what I mean. So we have a 1-1-2 trade, and once this trade hits a certain percentage profit, we can turn it into a ratio hedge and just have free downside protection. So a ratio hedge is created by closing the short put that is associated with the put debit spread. So you can see here, we bought one put, we sold one put, and then we sold two puts here. That's how we create a 1-1-2. Well, the thing is we want to create it into a ratio spread. What we do is we close the short put that's associated with the put debit spread. So if we close that, then our profit graph turns into this. What is amazing about this is this trade will cost us a lot more than a put debit spread hedge. It costs us $1,300 to have on, but it gives us at a max $22,000 of profit if it drops into our max zone. And this max zone is looking at basically, this would be a 700 point drop. If it drops 700 points, we'd make 21,000. Like we could even have the market drop over 1,000 points and we'd still be making money on this hedge. And so that's how amazing this is. It's not an infinite downside protection hedge like a put debit spread is, where no matter how far it goes down, we make money. It is limited, but the limit is literally down to $1,200. So the market would have to drop 1,200 points in order for us not to make money on this hedge. And then if it drops in this max zone, we make 21,000. So you can see here that a ratio hedge gives you a lot of protection. Now the downside is we have to pay a lot for it. A put debit spread, we're only paying about $200 for it, but we only get $1,000 of protection. Now we're paying about $1,300 and we get $20,000 of downside protection. And so that's how amazing a ratio hedge is, because again, 21,000, if we hit it, if we land in that zone, could cover up to like 5 different 1-1-2s if they all hit their max loss, right? And not only that, if the market were to drop, it's going to help offset and cushion any losses that we're experiencing while the market is crashing. And so a ratio hedge is very important. And I make sure to always have one on for at least 5 to 7 trades or something like that, so that I can make sure that I'm protected. So again, to recap, how do we turn the ratio hedge or turn the 1-1-2 trade into a ratio hedge, which is a great question. And so again, if we're looking at the positions tab here, what we do is we wait for this trade to get to around a 70 to 80% take profit, like the entire trade to get to an 80% profit. And once it does, then we just close out the short put, the one short put that is associated with the put debit spread. So the 1-1, we sell this one, and then that will leave us with the ratio spread. Now, if you're saying, Austin, I want this downside protection, but it's a bit confusing of all the different things I have to do, how can I automate this? Well, that's a great question. Well, you can actually automate it using this tool that I created called the Options Auto Trader. So what you do is you set up the rules for how you want to enter it, how you want to exit it, how you want your trades managed, and all the different trades in between. You can see here I have an ES 112 that's been completely automated for me for the last 3 months, and it's made me nearly $17,000 on complete autopilot. So that's how awesome this is. You can see here all these trades were entered automatically, where I told it how and when to enter, and it did. And not only that, I told it, hey, I want a ratio hedge to be on when you close the trade. And so look, I have a ratio hedge that's sitting here, and you can see that it's a hedge. And look, it's showing me that I have $24,000 of downside protection with this hedge. This hedge is costing me about $1,100, and the profit of that one put that I sold, so that profit plus the cost of this hedge will leave me with a net profit on this trade of $1,033, which is awesome. So I literally made a net profit of $1,000 and got $24,000 of downside protection. That's why you guys want to use ratio heads and use automation if you don't have the time. Now, what does that look like? Well, let me show you exactly how to create a 112 auto trader. So simply click on create an auto trader, connect your broker account, click on create an auto trader, click on a 112 trade, and then again, you can trade it with ES, MES, CL, whatever. Let's say you're trading with MES. You can structure it on the days until expiration, the different deltas you want to sell and set up the levels at. So again, 25, 23, 7 is pretty standard. How often you want to enter that trade, once a week, once a month, multiple times a week. You can set that all up here. If you want to enter on only red days, you can say that too. So again, all those rules here. We can set our take profit of 80%, right? We can set a stop loss of 300. And then guess what? If we want to turn this trade into a ratio hedge, when it hits 80% profit, we just simply say, hey, turn this into a ratio hedge. And that's how easy it is, guys. When this trade hits an 80% profit, it will turn it into a ratio hedge for you so that you have that downside side protection with the profit and don't have to do a thing. And so again, that's how amazing this is. Next, you tell it how much money you want it to trade with. Let's just say 5,000 for this example. And just like that, you have an auto trader. And you guys can see here, you just need to click save. But again, I already have two. I have one with ES that's made me almost 17,000, and I have one with CL that's made me 1,000 so far, because again, I'm trading with a lot less here. So guys, if you want to automate your 112s because you're busy, you have a family, you have work, or you just want more free time, then to use literally one of the greatest strategies ever, the 112, and automate it. Anyways, I hope you enjoyed this video. If you want to check this out, click the link down below. If not, I'll see you in the next video.